Good evening, members. Myself, C. Chawla, welcome you all in this today webinar on digital economy. And we are very honored to have with us C. Aseem Chawla ji, a very renowned chartered accountant and uh, practicing international taxation and running a law house in Delhi. So I welcome you, Chawla ji. And today he has very good topic and very unique topic on which I think the first time he is speaking on digital economy. So I request C. Aseem Chawla ji to please start his deliberation.
Thank you, Rajji. As always, you have championed the cause of propagation of knowledge amongst our professional community, and the sheer fact that you have been doing consistently speaks volume of your dedication and commitment to the profession. Yes, this considering the very imminent and recent tax policy changes which have happened at a very rapid pace, where countries are trying to figure out, although many countries still have initiated some unilateral measures, but the policy think tank and the key institutions wish that there should be some semblance of uniformity when you talk of the taxation regime or tax policy dealing with the digital economy, considering that COVID 19 has further accentuated the pace of digitization of our everyday life, and how digital economy has become the center stage of almost all activities. I mean, I wouldn't say it is pervasive, but then the sheer impact and more so the lockdown and the manner in which the reliance has been placed by each one of us in one manner or the other begs a lot of question for many jurisdictions as to how we should ensure a fair and equitable form of taxation of such businesses which can be felt, but unlike a conventional business, they do not have, so as to say, a place. So, therefore, the traditional taxation principles are being put to test. And the question is that are the existing tax principles sufficient enough to tax such businesses in a fair manner, and how these businesses should be taxed, and is there is whether countries could adopt a global consensus in terms of taxing such businesses, who should tax, how much uh, countries should tax, and what should be the basis of taxation. Otherwise, the unilateral measures which have been initiated by several countries, including India, might just lead to a situation where we end up having multiplicity of taxes at the expense of such corporations. Having said that, one school of thought is that they make supernormal profits, but the question is you can only tax an entity so much. But the sheer question is who should tax and how much it should be taxed. I mean, you can't expect uh, a big digital powerhouse to end up paying taxes in almost 190 odd countries. So that's the real question. So what we've done today, as you've been kind enough in allowing us to share our thoughts. So as discussed with yourself, we've kept today largely to set the tone and give the prelude, uh, which is today's session in terms of laying the foundation of tax policy and certain key global developments which have happened. So in the given time, we will try and do justice. I'm extremely grateful to my colleague Pulkit for helping me out in trying to condense what is happening all across the world. And very recently, also the OECD, just about a week back or so, invited public comments on Pillar 1 and Pillar 2. By 14th of December, those suggestions had to be submitted, which we were fortunate enough to be part of the International Bar Association tax working group in contributing that. I am conscious of the fact that the Bombay Society of Chartered Accountants have also made a submission, and I'm sure the Institute of Chartered Accountants and other policy think tanks would have made their comments to such proposals. So during the period of lockdown, hectic policy developments also did take place, which may influence the future of the principles of taxation of digital economy. But the question is how and when and in what manner. But clearly, some basic foundations and some key principles have been set in how they will develop in times to come. Uh, Countries in such difficult times are very keen to extract or ensure every pound of legitimate taxes are paid. So the question of there is a race against the time as we speak, and is this comes closely on the heels of the other international tax policy development which has taken place, is the setting in of multilateral instrument regime. So by the time MLI and its whole and the entire concept around MLI sets in and impacts the tax treaties of various countries, by the time it is setting in, we have this whole policy paper dealing with digital economy. So all in all, with these two developments, I think there is a complete rebooting of principles of international taxation, and therefore all of us have gone back to the drawing board. For some of us, the exercise is a little difficult to unlearn uh, and then relearn. I think for the younger ones, those who are very enthusiastic about international taxation, I think it could not have been a better opportunity to start now, because, as I said, everybody is pressing a refresh button. About a couple of years back, we've had major reforms in US, in which we will discuss. So may I request Shruti to help in sharing the screen, and we'll just take the help of the presentation uh, in moving forward. So let's move to the next slide and probably try and share with you what we have in store for today. As I said, we're trying to discuss the preface today, the Indian centric aspect of deliberations we will try and do on 26th. So the suggestion or the request to the participants is that if you have any queries or questions which deals with the provisions under the Indian landscape, be it equalization levy or be it ACP, or for that matter newly introduced 194O, or the amendments in section 9, or the draft rules of attribution which were unveiled by CBDT. So anything which has got to do with the scheme of Indian taxation, please you may either send your questions now, or we can park it for discussions on 26th, because on 26th we will just do what is all about India. And today we will just take you through very quickly as to what the key concepts are, how the world has responded, what are the key proposed global tax advocacy in terms of OECD's unified approach, Pillar 1, Pillar 2, and in response, or as not really in response, parallelly, United Nations has also mooted an amendment in the UN model commentary by introducing Article 12, capital B. So, all in all, today's interaction is to give you a quick high level view of what is happening all across the world. Pulkit has tried to compress all of this in in about few slides, and I'm sure uh, this could be a good interactive exercise amongst us to understand how the world is trying to keep pace with the given situation. Before we move on to the next slide, let's try and understand some key concepts. As students of taxation, we all understand that the jurisdiction to tax really stems from two important aspects. One is source and one is nexus. Now, digital economy or digital commerce or e-commerce, it completely defies geography. Now, the classical concept of permanent establishment, or the fact that you have a fixed place of business or a virtual projection cannot be applied to digital commerce for the simple reason that I may end up doing a great amount of business without even stepping my toes into the other jurisdiction, and everything can happen online or on e-commerce. And in that particular situation, uh, one can easily argue the fact that the right to tax uh, does not get conferred on the source jurisdiction if such income partakes the characters of business profit, and in the absence of a permanent establishment, uh, the the state other than the state of residence may not make cannot be in a position to make a case of taxation, especially in the context of treaty uh, being there in place between the two countries. So uh, in the case of e-commerce, where non-resident earns income from India without having such fixed place, how one would tax such income? And therefore, uh, one needs to revisit these settled conventional principles of taxation which are currently in vogue, and therefore the taxation of e-commerce or digital commerce necessitates a shift from the present normative system of taxation. And in some cases of digital or e-commerce businesses, the whole concept of PE might just being end up being redundant, so to speak. I mean, you can easily visualize a situation assuming that there are no regulatory hurdles, and you wish to order something from a given internet site and or from a marketplace. That particular commodity or particular article gets delivered to you. I mean, clearly, the marketplace may not have any presence in India at all. I mean, so at all times to come, one can easily argue it out that I don't have any place of business in the country, and of course, you could develop that argument saying that merely import of goods does not yield taxation because all the economic activities had happened in the country, the exporter country, and therefore the exporter country should have a right to tax. I've taken a very simple example, and you could probably build this on. Now, now, country of source shall have right to tax only such income which is attributable to the activities carried on by enterprise within that particular country, let's say source country. And double taxation avoidance framework suggests that country of source would restrict right of taxation, and country of residence will give credit of taxes paid if at all any taxes have been withheld uh, in the source state, and this pretty much mitigates or alleviates the whole concept of double taxation, which is one of the fundamental principle or the utility which is behind having double taxation avoidance agreement, that the intention is to ensure that income is not taxed twice. So far so good, I think. However, the situation gets a little more complicated where you have a country of residence, which we've just discussed, and you have a country of source. And then you have in this given scheme of thing, you could have another situation where you have the market jurisdiction, uh, which is the market, right? So when you have such a situation where you have country of market, you have country of residence, and you have country of source, then what happens? Let's build on the example a little more further. Let's say, let's talk about uh, a facility which is on internet, which provides data services, right? And and it charges certain fee for providing that data services, right? And at the same time, it also charges advertisers if somebody wishes to host an advertisement on that particular portal. I'm just using loose expression. So here you have a situation where you are making money out of two primary revenue sources. Let's say you're making money from provision of data services, and you're selling the data which you have collected over a period of time from all the users, and at the same time you're collecting or earning income from advertisers. Now, how do you collect data? You allow people to use your portal free, and as a result of that, you collect intelligible information about the users. Now, you're not charging any money from the users, but the amount of information which you are collecting from those users, you are monetizing that. So the more users you have, the more ability you have to mine data, and the more ability you have to monetize the data. So let's say India is a big market. You know, we have large number of internet users. So the bigger the market, the better the ability to generate information, and consequently the ability to earn more money by selling that data. So to whom you're selling the data? Let's say you're selling the data to a person of another country. So you've got a large number of users which are, let's say, in India, which is country of market, and then you are, let's say, you are residing in a foreign country where you've hosted your portal uh, or your site, and you are selling the data services to another resident of another country. Now, the state from which you are earning the income is the source state, where that particular person is there who is making payments for data services, and you have certain advertisers who are in another country. So you have advertisers in country A, you have data services buyer in country B, and you are collecting lot of data from country C, and you are residing in country D. Now the question is that where you should pay tax. Should you pay tax in country D where you reside, which is your country of residence, in the most conventional fashion? You should pay the data where you should pay the taxes in country A, where you have a lot of advertisers who are paying for buying ad space, or you should be paying taxes in country B, where you have persons or people who are willing or are paying for your data services, or you should pay some tax to the country where users are present, because your USP is large number of users. So let's say if you don't have that big market, then will you be in a position to generate that much amount of data? Will your website or your portal or your search engine be lucrative enough to be able to attract advertisers? So in this play of country of residence and source, which historically or conventionally has been the uh, has been the basis of allocating taxing rights between two countries, and pretty much double tax avoidance agreement deals with allocation of rights between the source country and the country of residence, and put these two together, the treaty will say, okay, country of source can tax this much, and country of residence has the principal right, and in between you settle the two. Because in many countries, when you pay the withholding taxes, you're discharged of further tax obligations, and pretty much the treaty settles and decides the issue. But in these now in the conventional space, you have a country of market also in between, and the country of market believes that it has a legitimate right to be allocated a certain percentage of profits being made by this search engine or portal. Because if there is no country of market, then the portal is not as attractive as it should be, and therefore that particular portal or search engine will not make so much of profit. So this is the conundrum which we have now. Moving further, uh, now where should one be taxing such revenues? Let's say we are talking of revenue of a search engine who derives revenue from an advertiser and from a data services. Now, where should the tax, and what should be the tax? Where the advertiser is situated, where the user is situated, or where the services are provided. Then Indian advertiser may want to pay for the Indian users, and Indian advertiser may want to pay for the foreign users. Foreign advertiser may want to pay for the Indian internet users, and foreign advertiser may want to pay for the foreign users. So, what should be the basis? Should the base be the internet user? Should the base be the advertiser, or should the base be both? Now, if one considers both internet users as well as the advertisers, then how do you formulate the basis of taxation? Now, foreign advertisers who are targeting Indian users, uh, and therefore you have a situation where this is not a case of foreign advertiser targeting a foreign user, which is completely, let's say, extraterritorial vis-a-vis Indian situation in India, should not have any right to tax. But where foreign advertisers are targeting Indian users, would India have a case to raise hand and say that where I should be having right to tax? But having said so, what fails this particular intendment of right is the lack of the current system of taxation, which may not allow under the given system of taxation read with the current framework of tax treaty for India to be able to tax such income, which led to unilateral measures in the form of introduction of equalization levy in 2016, and we understand that the scope got enhanced by Finance Act 2020 as it got amended because the bill didn't have those provisions, and the amendments to Finance Bill 2020 enhanced the scope of equalization levy. And similarly, provisions of Section 9 have been amended, and with 2A and subsection 3 capital A, although they have not been put into service for the simple reason that the world is trying to figure out a consensual basis of taxation. But having said that, the reason of equalization levy in response to or per the recommendations of the committee which was constituted was only to overcome the or trying to figure out a basis of taxing such forms of earnings which would have certainly failed in the given system of taxation. And that is where you had the decision of Wright Florist, where ad space was told, and being ordinary profits, it was not held uh, to be taxable. So I think I've given you a longer background than what I initially intended, but this helps in at least helps in crystallizing few important concepts in our mind. The fact that how the country of market suddenly has become important in the scheme of taxation, and therefore there is a strong economic justification for country of market to probably make a legitimate case of it also being allocated a certain portion of income slash taxes generated by these very big and powerful enterprises. So I think let's move forward, Shruti. Thank you very much for your good assistance, and let's look at the whole concept uh, of digital economy in terms of quickly going through the background and some concept. We'll rush these few slides because I think I've given a detailed background. Yeah. So when we talk of the fangs of the world, you have Facebook, Amazon, Apple, Netflix, and Google, who are pretty much part of our everyday life in one way or the other. And it is facilitating trade, provision of services through e-commerce, and main contents relate to, I mean, in digital market. And according to OECD, the main contents of digital economy relate to competition, regulation, and digital market, with additional discussion of networks, interoperability, open and closed platforms, etc. Rather than going by the bookish thing, I mean, as we understand, these are pretty much part of our everyday life now. So whether it is financial services, healthcare, manufacturing, media, entertainment, pretty much you find them everywhere. Supply chain management, consumer-facing business, automated digitized businesses, etc. Yeah. Next slide, please. Shruti, next slide, please. Yeah. So, where is India in the grand scheme of things? I mean, India's trillion-dollar digital opportunity suggests that we are amongst the top three global economies, and we have the second fastest growth rate of digital adoption, and digital divide is narrowing fast. And digital economy can create up to $1 trillion of economic value by 2025. And the way government perceives themes like healthcare, education, energy, financial services can accelerate India's progress and create up to again economic value of about $1 trillion. So this is the whole hope and confidence or promise which the digital opportunities do bring in. 90% of internet users usage on bank online, and 80% shopping online, and 65% of uh, kids will end up having jobs which have not perhaps been invented, and the global connectivity is all going to reach expand many folds. Yeah. Next slide, please. So why this uh, strong reaction by the rest of the world, or by economies, or by these policy think tanks? What was wrong? Why there is a need to bring in a new taxation regime, or why there is need to overhaul the existing tax regime? I think what got a lot of prominence several years back was this Google Irish Dutch structure, and we had similar backlash in respect of some other big multi national enterprises. I mean, we saw a backlash against Starbucks, but also, but that was largely on account of the manner in which it was structured, where it was not paying taxes in United Kingdom, where they had a maximum number of stores. So coming back to the Google thing, I mean, if you look at this particular slide, which we have sourced from the leading UK publishing house, The Independent, this is how the Google structure was looking like up until a few years back. You had the headquarter in California, and you had two subsidiaries in Bermuda. And the Bermuda company, below the Bermuda company, you had an Irish company which was incorporated in Bermuda, and interpositioned was a Dutch BV which had no employees. That is why it was classically known as the Dutch sandwich or the double Irish structure. And in between the Dutch entity, you had an Irish company, and all the revenues were getting collated at the Irish company level. uh, the Irish company ended up paying huge amount of royalties to the Dutch company. And why the Dutch company was interpositioned? Because of the fact that the Bermuda company, having its control and management in Ireland, was regarded as an Irish company, and the Dutch and the Irish treaty worked very well. So the entire monies collected in terms of royalties by the Irish company was upstreamed to the Bermuda company, which again was promoted by two Bermuda companies. So effectively, the tax outflow of Google under this structure was minimal in terms of the reasonableness which was expected uh, had it been a similarly sized conventional organized entity deriving income of similar manner in the conventional brick and mortar fashion, you know. So this has pretty much become the quintessential case study as to why the double Irish Dutch sandwich structure, which was uh, popularly quoted by the media all across the world to say that, well, they don't pay tax. I mean, they are big, they are powerful, but they don't pay tax. And this caught the imagination of almost all the policymakers, including the government all across the world. You know, now Google need not have a fixed place or uh, what we traditionally call as a PE or a permanent establishment where it provides services to the advertisers or to the data users. You know, Bermuda is clearly a tax haven, uh, and therefore there is hardly any semblance of high tax or moderate tax being paid at such countries. This was a large reason of the introduction of the US tax reforms, which we had post the Trump administration coming into power, and we had the introduction of GILTI and BEAT, which we will discuss very briefly. Uh, and a lot of persuasions made to tax havens to have an elaborate treaty network system. So, all in all, you have jurisdictions which are very competitive in terms of income tax. For instance, Ireland made an announcement in 2009 or 10. I remember I was in Dublin when it was getting out of the recession, that, and they made a commitment that well, for next 10 years our corporate tax rate will be 12.5%, which attracted a lot of attention and investments, and pretty much Ireland has become an IT hub. Not only Google, you have Apple and other big of multinational companies taking advantage of a competitive tax regime. So this is just some anecdotal tax structure as to help in answering the question that how did these structures worked and what were these structures all about. So I think it gives you some broad guidance. Yes, Shruti, let's move forward. So this is pretty much how the digital tax effectiveness rule to work. It's a little busy slide in terms of providing you some relevant theoretical background as to how digital taxation should work. I think it's very well crafted and quite self-explanatory in nature. Again, the blurring of lines, which we just discussed, and how technology is getting into the aspects of business, and you have new evolving models, and how digitization is breaking barriers, especially the entry barriers, and government at the same time are expecting or demanding a lot of transparency. We all of you are aware we have the data protection bill which is pending for legislation, which is one of the regulatory pursuits being undertaken by Indian government, that you are collecting data, and what are the measures you are doing under our laws, and therefore the whole contentious issue of having your own servers in India, because this is Indian data, and clearly this data should be in India. Uh, yeah, next slide, please. So, how aggressive have been multinationals? And at this point in time, there are three large issues which one can consider at this point in time. You have scale without mass. I mean, take for instance Oyo. For Oyo to have a valuation without really having so many per se owned properties, uh, it just speaks volumes of the scale. And then you have user participation and the value of data, which is data is the next oil, which we keep on hearing. And then significant reliance on intellectual property. So all these three are the key issues which are heart of any digital debate. The Guardian said that Facebook's UK tax bill rises to 15.8 million pounds, but it's just 1% of the sale. Look at the enormous generation of revenues being done by such enterprises, and the need largely being felt that is there a fair sharing or fair distribution of their revenues, where comes in the whole discussion which we had a little while ago on the markets being entitled to, whether the markets are entitled to that fair share of revenue. Yeah, next slide, please. So, what are the consequences? I think we've discussed that but just to sort of put it in tax phraseology, the existing rules of business connection and permanent establishment are pretty much redundant. There is a fair abuse of tax treaty provisions. There is an erosion of tax base from the source country, and the such convoluted structures may end up keeping ownership and control a little bit of opaque. And then of course you are amassing a lot of wealth in low tax jurisdiction and in tax havens. So these are the consequences of it. I mean, to think for a moment that Google has to do something with Bermuda sounds unheard of in a normal process of thinking, but these structures have been in place. Anyhow, let's see how the world has responded in terms of global response uh, to such situations. Next slide, please. Yeah. Yeah, next slide. So again, this is very well done so as to give you a very quick snapshot. In 2015, we had Plan 1 of the OECD's BEPS project, where we had 15 action points, and Action Point 1 dealt with challenges of digital economy. In 2015, UK introduced DPT, Diverted Profit Tax. In 16, India introduces equalization levy. As I said, 17, we had the US tax reforms. In 18, United Nations introduces 12A in the model tax commentary. The famous judgment of Wayfair versus South Dakota came in 2018. Then you have had European Union looking at DST. OECD comes up with a public policy and consultation. G20 looks at the new proposal as recently as in June 2020. France almost was the anvil of introducing the digital tax. And if you remember President Trump's statement that the moment France decides to impose taxes on US enterprises, we will stop importing French cosmetic, French wines, and French cheese. And that led to the postponement of the US pressure. And we all understand that US trade representatives have initiated inquiries under Section 301 with regard to unilateral measure. And I was checking this with the US business team here in India, and I understand that the 301 proceedings with regard to Indian equalization levy cognizance has been well taken, and we might hear from the US trade representative as to what US believes in terms of unfairness of India imposing its unilateral measure. And of course, in June 2018, as I said in the opening statement, that 12B has been uh, now by 12B in terms of UN's initiative of taxation of digital economy. And of course, in October, we had Pillar 1 and Pillar 2 and the public consultation which was launched, and by 14th of December comments were invited. So this is all what has happened. I mean, this is just an illustrative thing. I mean, there are other countries uh, which have initiated unilateral measures. Yeah, next slide, please. So for those of you who wish to know about BEPS, I think this is a great slide which gives you the wheels of BEPS in terms of all the major action points. And our discussion will follow on from action point 1, which addresses the digital economy. Next slide, please. Next slide, please, Shruti. Yeah. So action point 1 came up with following recommendations, which were followed by the Task Force on Digital Economy, which gave its report on 16th of March 2018. And clearly what action point 1 does bring forth, if we look at next slide, slide 13, please, I think we'll have, yeah. So, characterization of income is clearly an issue. Data and nexus we've already discussed, and then the whole challenge of administrating the whole tax baggage. Where is the service provider? Who is the seller? What kind of activities have been undertaken? How do you verify the information? So on and so forth. Yeah, next slide, please. If we look at the response, pretty much the action plan 1 did probably suggest that countries could look at imposition of either an equalization levy. You could consider having significant economic presence, or you could also consider having the taxation regime based on the intellectual property exploitation. So, uh, the alternate to PE, which is the significant economic presence test, has been now incorporated in domestic tax law, both in India as well as in Israel. Also, you have whole concept of virtual service PE. Uh, then you are looking at withholding tax, broadening the definition of royalty. You can look at some kind of turnover taxes. For instance, Hungary has introduced, and we have equalization levy in India. And then you have specific regimes for large multinational companies such as UK and Australia. And then you have a virtual service fee concept, which is being imbibed by Saudi Arabia. Yeah, next slide, please. So the European Union response, again, we've tried to give you the timelines of several initiatives undertaken. I would rather suggest the participants to go through this slide, and we could move on, please. Yeah. So, what is a DST, which you will often hear as, and equalization levy could be a variant of DST. It's a low-rated tax imposed on portion of gross revenue derived from activity, and it is the nexus is created by local users, and a global revenue threshold looks at businesses' annual revenue, and in some cases you may have some safe harbor or thresholds on the imposition of DST. While some countries have implemented GST, not all DSTs are permanent. In fact, when India introduced equalization levy in 2016, it was widely believed and understood that this is a temporary levy, because as and when a global consensus based solution is reached, then you need not have DSTs. But the regressive part has been that the scope of equalization levy has now got extended with the amendments made to Finance Bill 2020. And till the time we don't have global consensus, which uh, doesn't seem to be on the anvil shortly, uh, the OECD also looks at about 2023. So till such time, these unilateral measures would be pretty much a permanent feature, and in that situation, would the countries who are deriving or drawing some revenues from such unilateral measures, will they be enthusiastic enough to withdraw it? I mean, we had clearly some forms of cesses which were introduced as a temporary measure, but they still continue to be. So the tendency of having introduced, and which stays for good 7, 8, 10 years, when a consensus-based approach is finally agreed upon, then will this be withdrawn by such countries? I think that's a concern at this stage. But till the time there is no global consensus, you would have more countries in standing in the queue with regard to impositions of such unilateral measures. Yeah, next slide, please. So these are certain pitfalls or drawbacks which comes out of GST. I mean, in Indian context, equalization levy uh, is certainly not regarded as taxes in its conventional sense, and if it does not form part of taxes covered, then clearly they are not creditable. And the reason perhaps they are not creditable could be the fact that if you end up allowing credits, and the service provider does not have a PE in India, clearly it might lead to a situation of either credits or refunds of such levies, because in the absence of any place of business, how these taxes can therefore be actualized, so to speak. Yeah. We'll discuss the equalization levy concept and the challenges associated in our second segment, which is on 26, which pretty much uh, brings the India perspective into this conceptual discussion which we are having today, and looking at the developments which have taken place across the world. Yeah, next slide, please. Yeah, so what's the status of countries on 301 probe? I just spoke about that. So this is the backlash of the United States with regard to imposition of unilateral levies. Yeah, next slide, please. So if we look at the UK DST, it's a 2% tax on third-party revenues on certain business activities which are in scope digital businesses. There is a threshold in as much as you need to generate more than 500 million pounds from such activities, and more than 25 million revenues from activities linked in participation from UK. And if you look at the UK Treasury paper, it says it's a narrowly targeted and a temporary tax, and to be replaced by a comprehensive global solution. This is exactly what India has said. And if you look at the background papers to our finance bill with regard to uh, either the introduction of levy or the deferment of provisions relating to significant economic presence, pretty much you'll end up hearing the same hearing the same sentiment, so to speak. Yeah, let's look at the next slide, please. Now, from UK, we come to France. It was enacted on 24th of June, uh, but then to wait for a global international solution. This is exactly what you have heard in the UK context also. Yeah, let's move forward. So, what is happening in the United States itself? Now, clearly, you need to understand that the big fangs are, most of them are US originated, and therefore, US's imperative of taxing them may be entirely different from the lens which a source country or a market jurisdiction would have. Uh, from a US perspective, one big concern was these big corporations setting up these complicated structure in tax haven, and therefore the returns or the revenues weren't coming back onshore. And as a result thereof, the US did introduce some measures which is popularly known as GILTI and BEAT. BEAT is the equivalent, not really the equivalent, pretty much an anti-avoidance regulation, more on the lines of GAR. So it's not that US does not wish to tax them, but as I said, US's imperatives are slightly different from the imperatives of the market jurisdiction and the source country are. Yeah, next slide, please. So you've got US states. We all understand income tax is a state concept in United States, and states are also empowered to levy taxes. And the whole nexus approach, shifting away from physical presence, happened with the US Supreme Court landmark decision in South Dakota versus Wayfair. Wayfair arose from a challenge to a South Dakota law which was designed to capture sales tax from online sales through remote selling. And the court held that the company had sufficient economic and virtual contact with state, and therefore there was an adequate nexus requiring the company to collect taxes. Now, since the Wayfair decision, states have implemented various thresholds in case of remote selling and virtual contracts. Yeah. Next slide, please. So these are the state sales tax which you will find now in vogue amongst several states within the United States. Yeah. Next slide, please. Yeah, this is the BEAT tax. In 2017, BEAT was introduced, which was targeting corporations that would make sure that the net income tax applies for certain incomes which are adjusted. The tax effect businesses where receipts are in excess of 500 million US dollars. The idea was that there should be a fair payment of taxes, and while computing the tax base, there were certain adjustments from cost of goods sold which are generally excluded. I mean, some sophisticated formulae were in place. So this was introduction of BEAT, and let's look at next slide, which deals with GILTI. Yeah. GILTI was pretty much a measure to bring back or dissuade the United States corporation from holding money abroad. So it was a new category of income under which what the US has done is to ensure. If you look at this particular slide, GILTI is if you have a situation where you have an IPR dominated business, then you would where earnings did exceed 10% of return on companies invested foreign asset. So let's say you have foreign assets and your earnings from such foreign assets which are in excess of 10% of such foreign assets, then looking at the worldwide minimum tax between 10 to 13% on an annual basis, the GILTI is supposed to reduce the incentive to shift corporate profits out of United States by using intellectual property. So the purpose of GILTI is to reduce the incentive for US-based multinationals to shift profits out of United States into zero or low tax jurisdiction. This is done by placing a ceiling on the average profit tax rate paid by US multinationals between 10 to 13%. So if you look at 21% average corporate tax rate in United States and compare it with 10 or 13%, rather than a zero rate. So if you have foreign assets and your earnings are more than 10%, then this will be the qualifying category. So the idea is to tax high to tax such enterprises which have very high foreign profits and are not paying taxes there, and if you compare it with the United States, where you have tax rate of 21%, what GILTI does is to tax the instead of tax. GILTI is to tax by giving this margin of 10 to 13.125%. So the difference is tax saving a company receives per dollar shifted. So if you shift all, then you pay taxes. But if you don't shift all and you bring one, then you get this. So companies can face US taxes even if their effective tax rate is in excess of 13%, which has been one of the drawbacks of GILTI. What the US lawmaker said that you will not have to pay taxes if your foreign tax rate is more than 13%. but that is not working out. So let me sort of break it down and attempt to sort of uh, explain it in a little more simplified manner. The lawmakers wanted to work on legislation to ensure that minimum 10.5 to 13% of taxes are paid on foreign profits. Now, if they are not being paid, then to that extent, guilty comes into picture. So if you are in a low tax or a zero tax country and you're not ending up paying taxes in this particular range, then you will end up paying additional taxes in the form of guilty. So it is supposed to reduce the incentive to shift corporate profits out of United States by using intellectual property. But it has gained a lot of attention in United States because of unintended consequences. You've had situations where corporations who are working in high tax environment, Mexico, etc., have ended up paying guilty because of the manner in which these computations are done. So it's pretty much an outbound anti-base erosion provision in a way, because you are eroding your base of your home country by ensuring a lot of profits are parked outside in a low tax or a zero tax situation. So this is what the guilty is. So if you look at the second bullet, it's calculated as total active income earned by a US foreign affiliate that exceeds 10% of depreciable property. A corporation can generally deduct about 50% of the guilty and claim foreign taxes for 80% of the foreign taxes paid. So thus, if a foreign tax rate is zero, the effective US tax rate on guilty will be 10.5%, which is half of the corporate tax rate, which is 21%. But if the foreign tax rate is 13.125% or higher, there should not be any guilty after 80% of taxes, 80% of foreign taxes. So guilty income is included in currently taxed income, but a 50% deduction for this income is allowed for taxable years beginning 31st March 2017. So the second bullet pretty much clarifies it. So you have a situation where you could deduct 50% or you could claim 80% of foreign taxes. And if the foreign taxes is 13.125% or higher, there will be no US tax after the 80% credit of foreign taxes. Next slide, please. So what has been the Indian response? We've had the expanded definition of royalty and fee for technical services. We all understand in 2012, the definition in the domestic tax law was expanded. In 2016 was equalization levy introduced. New nexus rules in the form of SCP were introduced in 2018. Then you had SCP getting deferred, expansion of equalization levy, which we've had. Then we are very active at the international tax forums, both in United Nations as well as in the OECD G20 inclusive framework, and therefore we have a voice which we speak. Yeah. Yeah. Raji, can we take just 1 minute of break? I think we'll just take a break for a minute and then I'll join back. Just give.
Sure, sir. Sure, sir. Please. I request all the members watching this our webinar on digital economy Please wait for a while. I also want to inform all the members that the second part of this webinar will be held on 26th of December from 4 to 6 p.m. So this webinar has two parts. One part we will cover today, and another half part we will cover on 26th of December. Also, I would like to inform that if you need this presentation, kindly send me your request on my email ID, that is rajchavlaca@gmail.com. So we will provide you the PPT shared by our today's speaker, C. Aseem Chawla ji. And if you have any queries, you please post your query in our comment box so that our speaker will reply all the query related to our today webinar after this session. Welcome, sir. Welcome back.
Thank you. Yeah, thank you. Okay, so that was the India response, having just quickly gone through what has happened in the rest of the world. Now, let's move on to the next slide and look at some global tax developments which have taken place in India. This pretty much we'll cover in the 26th thing, so we can skip Shruti slide 28. Yeah. Let's move forward, please. Yeah. Next slide, Shruti. Yeah. So what has been the proposed global tax advocacy on this? We all understand that OECD and United Nations are two voices of global tax advocacy. Of course, very recently we've had the African voice, the ATAF also, and they are also trying to take a consensual view amongst the African countries. So the world largely has seen OECD in a dominant position, but in the past few years, the UN Tax Committee has also become very active in terms of making its voice being heard amongst the developing countries. So let's see what both UN and OECD have said or viewed their thoughts with regard to digital taxation. Yeah, next slide, please. So we saw the action point one in terms of the BEPS package and OECD coming recommending pillar one and pillar two. The United Nations also released a draft proposal with regard to right to tax cross-border payments for automated digital services, which is Article 12B. And at the same time, in the right-hand side of the slide, you will pretty much figure out a survey being done with regard to how countries have lost taxes out. And if you see on top of the line, you will find an island known as Cayman Island, so to speak. Yeah. Next slide, please. These have been pretty much the OECD's initiative. As I said, OECD has been in a dominant position because of its being highly proactive or seizing the initiative, so to speak, right from the BEPS project in 2013 up until now, with uh, the unified approach, and this pretty much pans out to the next slide also. Yeah, from 20, let's see what OECD has done in 2020. Yes. Yes. Yeah. Moving ahead, the key measure which OECD has recommended most recently is the unified approach UA. Next slide, please, Shruti. Next slide. Yeah. Next slide, please. So, in October 2020, OECD released its latest reports. As I said, consultation was sought in terms of submission by 14th December, and two work streams, one which is Pillar 1 and the other is Pillar 2, outlines the OECD approach in terms of a unified mechanism of trying to figure out whether this could result in some basis of coming to a global consensus on taxation of digital commerce. So both Pillar 1 and Pillar 2 do not represent at this moment a view of the inclusive framework, G20, uh, and other countries, but these, according to OECD, these reports intend to provide an outline which could be a basis of consultation and maybe uh, bring up a political consensus amongst countries and adapting some variant or form of this. So this could be a good food for thought, somewhere to begin with. This is what OECD believes. So let's very quickly look at Pillar 1, what Pillar 1 is all about and what Pillar 2 is. We'll quickly run through so that at least amongst the participants we have some assimilation of these broad concepts. By the time they formulate, how they formulate, time will tell whether we will have another version of multilateral instrument 2.0 and therefore countries adopt this, or there is no political consensus on this. As I said, now you've got three players. You've got source country, you've got country of residence, and you've got the market jurisdiction also in between. So this requires hectic consultation amongst all the stakeholders. Yes. So let's look at Pillar 1, please. Pillar 1 addresses the taxing rights and nexus rules, and Pillar 2 outlines the global minimum tax, which is also known as GLOBE. Yeah, next slide, please. So, what are the key elements of Pillar 1? Pillar 1, to understand Pillar 1, you need to pretty much take into consideration there are some key connotations. One is amount A. What is amount A? It's a new taxing right allocating a share of residual global profits to market countries using a formulaic approach, regardless of the fact that whether that corporation has any presence in that market, and which are the qualified businesses which are defined as in scope business. So let's say you're a Google of the world, you don't have any presence in Nepal. Nepal is a key market for you depending on some calculations which are done. And if the answer is yes, and if that formula works well, and Nepal's uh, uh, barometers in terms of users, revenues, etc., works well, then Nepal might be entitled to certain revenues, certain tax revenues of Google, regardless of the fact that Google may have never stepped in physically in Nepal, which pretty much breaks the barriers of uh, the source rule with which we started our discussion. That unless there is a source, how can you the state will have right to tax. Then you've got amount B. Amount B is a fixed return for certain marketing distribution functions taking place physically in a market jurisdiction, in line with some arm's length principle. So you've got amount A, regardless of physical presence, for certain kind of businesses which are defined as in scope. Amount B, some return for some activities being done where you are physically present, on some arm's length basis, and then you achieve some tax certainty by ensuring that you have dispute resolution mechanism. Imagine a situation of 190 odd countries. Everybody is fighting for saying that one corporation uh, tax revenue. Imagine the plight of the tax manager of that company, who may end up standing in witness box in almost 190 countries, and where 190 countries are making a fair share of taxing the profits of that particular one entity. Not one entity having subsidiaries, branch office, liaison offices, but just one company, let's say. Yeah. Yeah. Next slide, please. So let's understand what is amount A. Now, amount A works on a sort of a mathematical formula which takes into consideration automated digital services. Now, which are digital services which are can be regarded as automated digital services, or ADS? ADS are those services which are largely digital and does not require any human interventions. So what would be included in ADS? If you look at the plus sign, online advertising services, search engine, social media platforms. What would be not included in ADS are things like customized professional services, uh, online sale of goods and services other than ADS, revenue from sale of physical goods, some customized online teaching services. So this is what would go into what constitutes ADS services. Yes, next slide, please. Then you have a concept of something known as the consumer facing business. Shruti, can we move to next slide, please? Now, what are consumer facing businesses? Now, consumer facing businesses are those where sale of goods and services of a particular type are commonly sold to consumers. Goods and services would be regularly or repeatedly provided to an individual, and sale would comprise licensing, rentals, delivery directly or indirectly. So these are what are commonly known as CFB, consumer facing businesses. What are excluded are airline, international air shipping, leasing properties, extractive mining, and natural resources. Right? Having understood these two concepts of businesses, which the OECD wishes to categorize under the ADS or the CFB businesses, now let us understand the nexus thresholds uh, applicable to such businesses. Yeah. Next slide, please. So there would be some thresholds for ADS services. There would not be any plus factor for ADS, but yes, for consumer facing businesses, there would be plus factors. Now, what are plus factors? They indicate some sustained interactions with market, could include some fixed place of business, some PE, revenues above a given threshold. So please keep in mind the thresholds which will be applicable to the ADS or to consumer facing businesses. Yeah, next slide, please. So how would one map out revenue sourcing? I think these are the principles which are relatable to revenue sourcing. I mean, the slide is quite self-explanatory. Please have a look at it. We move to the sourcing rules pertaining to ADS. Yeah, this is important. Next slide, please. So revenue from online advertising services, revenue from sales of data, online intermediation platform services, digital content services, and cloud computing services. These are the services which are not, these are the services not mentioned, use the sourcing rule. So in other words, services not mentioned here use the sourcing rule of the below mentioned ADS services. So for ADS, we have the sourcing rules mentioned in slide 41. Services which are not mentioned here in this particular slide will use the parameters given in slide 41. Yeah. Next slide, please. So what are the sourcing rules with regard to the consumer facing businesses? Revenues from uh, the businesses where goods are sold directly, either through a distributor or from a franchisor, or in where you get some information about location of consumers. Now, how do you now put all this in determining the tax base? We've understood the two kinds of businesses. We've understood what are the sourcing revenue sourcing rules. Now, how will we all dovetail this into determining the tax base? Yeah, next slide, please. The amount A tax base will be quantified using some adjusted profits that will be derived from the consolidated balance sheets. Segmentation will be required. Now, whether that segmentation will predicate upon some established and recognized method of accounting and the applicable accounting principles utilized for the purpose of presentation of financial statements. Then the losses carry forward would apply, but there are some key issues open with regard to treatment of the losses prior to such provisions which were to come into service. Then the standardized profit before tax, we start with the total profit and loss of the consolidated M&E and adjust for the following expenses. We add back income tax, we exclude dividends, and then we add back certain expenses which are non-deductible, such as bribes, etc. Yeah. Next slide, please. All the multinationals will require to break down their revenues between ADS, CBF, and other services, and then to limit the amount of multinational group required to segment their amount A tax base. For instance, M&E groups with global revenue less than, let's say, $20 billion. This is just an example. And then you could segment them and have a transition period of 5 years or so, end up computing the tax base. So that's the second process. The third step is that these are the groups which are not eligible for choosing the exemption, and then you've got certain principles on segment accounting. Now, how will you allocate the profit? That is explained in slide 46, please. The formula will apply the tax base of each segment after deduction of losses and involves the three step to determine the quantum of amount A in each jurisdiction. Now, Nepal wants to know what is the amount which is attributable to Nepal out of this entire exercise done. So, first of all, you will have the thresholds based on some profit before tax divided by revenue. Now, OECD uses a 10% threshold. Then apply the application of reallocation percentages to identify shares of residual profit to allocate to market jurisdiction, that is the allocable tax base. OECD uses 20%. So first of all, you find out what are the profitability threshold. On the profitability threshold, you apply a reallocation percentage, apply an allocation key based on locally sourced in-scope revenue, and there could be two possible approaches, either a profit-based approach or a profit margin-based approach. And then in either of the situations, in profit margin-based approach, you multiply it by local in-scope revenue, or in the profit-based approach, allocable profit is multiplied by ratio of in-scope revenue to total revenues. Yeah, next slide, please. So let's understand this by way of an example. Amount A formula, let's say, includes 10% profitability, which is step 1, and 20% reallocation, which is step 2. Let's say a multinational enterprise has $25 million of revenue, profit before tax is $6.5 million, and profit margin is 26%. Step 1, find out the profitability threshold. Profitability margin we know is 26%, and profitability, so residual margin is profit margin 26 minus what is the threshold? Threshold is given 10%, so in excess of 10%, 26 minus 10 is 16. You freeze 16 here. Step 2, reallocation percentage. Residual profit attributable, whatever we figured it out, multiplied by the reallocation percentage, which is 20%, you get 0.032, right? So let's say you have now local revenues which are of 25, 2 from market A, where there is a subsidiary, market B, no PE, market C, no PE, 2 million, 18 million, and 5 million. If you look at the residual profit margin of 0.032%, which we have figured out in step 2. Step 2 is the profitability threshold which we arrived in step 1 multiplied by the reallocation percentage of 20%. We get 0.032. Now 5 million multiplied by 0.032, you will get $64,000, which will be allocated to the market A, market 1. Market 2, you got another 5 million multiplied by 0.032, you get 576,000, and that is how the entire 800,000 gets divided amongst the 3 market jurisdiction. Yeah. Let's move forward, please. So how do you eliminate double taxation? I think these are the steps. You will qualify activities, then you will undertake a quantitative test. Amount A tax liability will be allocated, remaining amount will be apportioned, and then liability will be allocated, because elimination of double taxation would be a big scare for such big enterprises. Next slide, please. So how do you figure out amount B, which is the base, the remuneration related to baseline marketing and distribution activities, which is aligned to arm's length principle. It applies potentially to all business sector and is not subject to any scope limitations. We will identify some activities through a multi-step process, and as a result thereof, you have a narrow scope approach. After the in-scope entities are identified, a fixed return is used, and then there are certain proposals which the OECD has suggested that this might be considered for the purposes of determining amount B. Yeah. Next slide, please. What are the positive functions and the negative functions which have been identified while determining uh, the activities? At the end of the day, you are remunerating in respect of certain marketing and distribution activities which are aligned with arm's length principle. Yes. Next slide, please. Now we come to pillar two, which is known as GLOBE, which talks of global anti-base erosion proposal. From an India standpoint, pillar two will not be of much attraction because as a market jurisdiction, we are more keen in pillar one to identify or ascertain how much taxes will get finally allocated or shared or distributed to the market jurisdiction. But why it is important to understand the concepts of pillar 2, which is globe, is to figure out that the countries do undertake a coordinate effort to ensure that many big multinational enterprises do not shift profits to jurisdictions where there is no or little tax, as we just saw the Google erstwhile Google structure, right? Now, what is important for pillar 2 is the fact that to ensure that the effective tax rate of such multinational enterprises is not below a given threshold, and therefore these three concepts are very important: IIR, which is income inclusion rule; UTPR, which is under tax payment rule; and most importantly, subject to tax rule, which is STTR, right? So all these four concepts have been well detailed out in the next slide. If we move to slide 54, please. Now let's start from the bottom right, STTR. Subject to tax rule suggests the fact that a source country tax base is protected by bringing to tax certain incomes which otherwise have been ceded away by the tax treaty. Now, let's say certain payments or certain incomes by virtue of tax treaty have been allocated back to the state of residence, and source state has given up the right to tax. They are brought back to tax under the STTR. Now, where certain royalties or high risk services which are subject to no tax, the source jurisdiction may apply withholding tax to bring up the total up to agreed minimum rate. Now, developing countries feel that Pillar 2 proposals may not excite them, but things like STTR would help in preserving their tax base, and therefore it is important for the developing countries to keep a tab on the formulation of such rules. Apart from that, you have IIR, which is income inclusion rule. It taxes the income in the hands of the parent of a foreign branch if the income is subject to tax at a effective tax rate that is below a minimum rate. If that be so, then it will be added. Then you have UTPR, which is under tax payment services, which serves as a backstop to IIR, allowing jurisdiction to levy a top-up tax on any untaxed income, any low tax income which is not already subject to IIR. And then finally, you have switchover rule, where a parent jurisdiction is required by treaty to exempt the income of a PE in the hands of resident head office, and no additional tax would be possible. To counter this, switchover rule permits the parent jurisdiction to switch to a credit method and levy additional tax on PE's income subject to an agreed minimum rate. Yeah. Next slide, please. So additional tax on otherwise low taxed income. Now, having understood IIR, UTPR, and STTR, now STTR applies in priority to IIR and UTPR, although its operation is limited to covered payments, which is defined which is defined as interest, royalties, guarantee, brokerage, financing, insurance, reinsurance, franchise fee, etc. Now, importantly, no minimum effective tax rate has been publicly proposed and is likely to be an issue of debate. it should be ranging between 10 to 15%. The nominal rate for STTR will be even lower. Now the threshold, the rules apply to M&E group that are subject to CBCR 750 million euros, which is the case in Pillar 1 also. And about 2,300 companies are expected to fall within this threshold of 750 million euro, which is even the CBCR reporting threshold. Now, how the top-up tax allocation will happen, let's look at the next slide, please. Yes. So if you have an IIR inclusion, will it apply to intermediate parent? The answer is no. Will it apply to the undertax payment rule? The answer is no, but it will apply to the intermediate parent. Yeah. Next slide, please. And now with this, I'll quickly run through the UN proposals. My apologies, this was quite technical, but then we've tried to simplify very, very complex drafting of the UN proposals. Now, the interplay of GILTI with Pillar 2 is something which OECD is very conscious, because if US does not buy in uh, Pillar Pillar 1 and Pillar 2, then pretty much, which the current position is, then pretty much the global consensus will elude this blueprint of OECD, and therefore the Pillar 2 proposal tries to make a case of good harmonization with the GILTI provisions which we just saw. Yeah, let's move forward. Next slide, please. Yeah, so let us look at the UN proposal of Article 12B. Now, UN is talking a very simple thing. It says you bring in Article 12B and let the countries bilaterally negotiate their tax treaty, agree on a withholding tax rate in respect of ADS services income, and that's about it. The choice could be given either to tax on a gross basis or on a net basis, and both the countries can bilaterally negotiate and incorporate 12B rather than going through this long drawn process of Pillar 1 and Pillar 2. What is ADS? ADS is defined as any payment in consideration for services provided on internet on electronic network requiring minimal human intervention, and whatever is covered in fee for technical services in the preceding articles 12A will not form part of 12B. So this is a very sort of a simple proposal. A comparative is provided in the upcoming slide. Let's move to the next slide in the interest of time, please. As I said, you could have a choice either to adopt at a gross basis, which is withholding tax at source, or on a net basis. The rationale is that the global solution is too complicated. 12B is a simple alternate for countries which have withholding tax regimes. It is restrictive in its scope to ADS services. You can claim tax credit in respect of withholding taxes undertaken, and the UN committee will continue to this, and the text will get finalized in April 2021. Having been an observer to the UN committee's deliberations, which took place a couple of months back, this was something which was highly debated, and after much deliberations, and credit goes to India also in terms of pushing this through. Otherwise, this particular article may not have seen the light of the day. And in the 22nd session, which is scheduled in New York in April, I think the text hopefully will get finalized. A quick comparison between the UN Pillar 1, Pillar 2 unified approach and Article 12B is presented in the next slide, please. Yeah. So As I said, UN's scope does not take care of consumer-facing businesses. There are no thresholds in UN. You could do a gross or a net basis. Uh, the UN is more bilateral. Uh, the OECD proposal is multilateral. As I said, it might be just MLI Part 2 in the offing. It's very complicated, and the profit allocation in the Pillar 1, Pillar 2 approach is premised on net taxation, and developing countries can tax ADS and consumer-facing business in many cases. Now, the OECD feels, and we had the opportunity to listen some reactions that this is too simple to be true. So that's I won't say a cynical approach or a cynical reaction, but that's the reaction. So what's the road ahead in terms of the whole tax landscape dealing with digital economy? Just to conclude and summarize a few thoughts which I have. Look, technology is moving fast, and therefore there is a great amount of scrambling which will happen between the corporations and the tax policy and the tax departments of countries to keep a pace with all these developments. And this is a fast moving, ever evolving business, and it will continue to mutate. So, by very nature, tech businesses do take pride in being very fast moving. So, therefore, the whole aspects of tax compliances uh, would be a daunting task for any administration to keep pace. Next slide, please. And the US Treasury has gone on record to say that countries should be dealing with pandemic and have called the OECD to suspend its work. And they have pulled out in terms of their discussions with the EU counterparts and have said that you should wait, don't impose any unilateral measure at this stage, otherwise we'll have retaliatory measures. Let's see what comes out from the 301 US trade investigation. India is also being investigated because of our unilateral uh, levy of equalization levy. Yeah. Next slide, please. There is a lack of consistency, which might create problems for such big businesses. Uh, the UN proposal is a simple solution, but whether it is a sustainable solution. So the issue of taxation of digital economy is a sensitive issue, and if timelines are not met, which is 2023, it's likely that there would be proliferation of domestic taxes. Unilateral measures would uh, be seen more in plenty, uh, and therefore countries may find in a situation where they have no choice but to impose unilateral measures if they don't get a fair share of taxation pursuant to some policy consensus which is achieved. I think the US buy-in is very important for all the reasons, and there at this stage US is not even a party to MLI, and whether it will be a party to MLI version 2.0 post the outcome of unified approach, I think time will tell. Maybe in a year or towards the end of the year, towards the end of the next year, or beginning 2022, there will be some semblance of clarity. Uh, whether this particular the upcoming tax proposals in India would have further tax revenue drive in terms of digital economy having done so much. I think it would be better to wait and watch and actively participate and collaborate in these global consensual discussions. And I'm sure with Rajji's great encouragement, we will get an opportunity to see how things have developed. Maybe uh, in a few months' time on this very fascinating yet very complicated subject of digital economy, where the world is trying to see that if it can sing one tune, which is a common theme, so that all countries can adopt pretty much one uniform measure of taxation. With this, I rest my today's deliberation, and I do look forward to continuing and picking up threads when we congregate again after Christmas on the 26th. Today is a day of supreme sacrifice also, uh, and I take this opportunity to thank Rajji once again for all the encouragement forthcoming, and my due acknowledgements to my young colleague Pulkit.
Thank you very much, sir, for a wonderful deliberation on this digital economy, a very new concept and chapter for the profession. So I am very much thankful to you. And I hope there is no query because this is the new subject. So no queries there. So members are requested, if they have any query after this session, they can send me on my email or WhatsApp. I will request our guest speaker, Aseem Chawla ji, to answer all the queries raised by our members. So with this, I am thankful to Aseem Chawla ji for a wonderful deliberation on this digital economy, and thankful to all the members attending this our program for today. We will also share you the video of this program so that you can after any time you can watch this our program. And if you need the PPT of this program, then you send me the request. So I will request CA Aseem Chawla ji to share the presentation to all the members requesting this PPT. So with these, I am thankful to all of you. Thank you, sir. Good evening.